Hello and welcome to Achiever. If you're planning to become a certified facility manager, you have come to the right place. We are here to guide you step by step. In today's video, we will dive into the chapter number 1 of Finance and Business, which is one of the key competency of CFM. Chapter number 1, Finance and Business in the Facilities Organization. What to expect in this chapter? This chapter will introduce the role of finance and business in the facility management and explain basic financial terms essential for managing facilities effectively. So we need to understand why finance and business is so important in FM, means facility management. So facility management plays a crucial role in supporting an organizational financial goal, contributes to the bottom line by optimizing resources, improving energy efficiency, and reducing waste. For example, implementing energy efficient system can significantly lower the utility bills while promoting sustainability. Next is impact on operational cost and investment. FM decisions affect both day-to-day operational cost and long-term capital investment. A good example is predictive maintenance. By addressing equipment issues early, FM can avoid costly repairs and maintenance which can occur later on. So next is aligning facility management with the organizational objective. When FM strategies are aligned with the organizational goals, they enhance both profitability and sustainability. Role of the facility manager as in finance and business. Okay, so facility managers are not only responsible for maintaining buildings but also play a key part in managing financial resources and contributing to strategic decisions. So let's break it down. The first one is prepare and manage budgets. Facility managers are responsible for creating and managing the budget for facilities operations, which includes cost for maintenance, utilities, staffing, and any upgrades or improvements. And by carefully planning and controlling these costs, they ensure that the facility operates within its financial limits. Next is analyzing cost and financial reports. Facility manager regularly analyze cost and financial reports to identify any discrepancies or area of improvement. And also reviewing operational expenses like energy consumption and looking for ways to optimize resources which directly impact the bottom line. Next is oversees procurement and contract management. So facility manager also oversee procurement process, ensuring that goods and services are purchased at the best possible price without compromising the quality, and also manage contracts with external vendors, ensuring all terms are met and the service provider deliver value for money. Next is contribute to the strategic decision making. Beyond day-to-day operation, facility managers contribute to the strategic decision. For example, they can provide insights, energy efficiency improvements, or office space utilization, helping the organization achieve long-term goals. Basic key financial terms used in the FM. The first is operating expense, which is also called OPEX. Operating cost or OPEX cover day-to-day costs like utility and maintenance. Next is capital expenditure, which means we can also call it CapEx. So capital expenditure involve larger investments such as new HVAC system or building renovation, like installing new chillers or extending the building area, extending the parking area, any kind of like improvement we can include which is beneficial to the company in long term. Next is return on investment, which is also called ROI. ROI. ROI helps to measure how profitable a project is. How do we calculate the ROI? ROI is net gain from the investment. Next is net present value. Net present value evaluate the current value of future cash flow and the next is total cost of ownership. Total cost of ownership is all cost of owning any operating an asset over its life cycle. For example, if we are purchasing a car, for example, this is costing us 100,000 right now. So this is not the cost. This is the actual. This is the initial cost which we spend in buying the asset. Okay. So like for example, if we will drive this car for next 10 years, so like petrol expenses, maintenance expenses, and insurance expenses. So whatever the cost will be there, so that all the cost we need to calculate, and whatever the final cost will come, so that will be the cost of ownership. So in facility management, it is very important to understand what's total cost of ownership. For example, if we are installing any new chiller, so we need to calculate the cost of ownership. What will be the cost of ownership? Like for example, if we are getting X cost of ownership, so we need to know what will be the ROI on that. Like for example, if we are spending 100,000, so what will be the ROI, return on investment? If we are investing 100,000, so what will be the benefits? Next is forecasting. The forecasting is predicting future cost and revenue based on the historical data. For example, estimating next year's utility bills based on the current year's energy consumption. Next is fixed cost. Fixed cost expenses that do not vary with usage. For example, monthly rent for office and insurance premium. Sometimes insurance premium can also vary, but this is kind of fixed cost. Next is variable cost. Variable cost that fluctuate based on the activity levels. Uh, for example, water and electricity bill that increase during the peak. Direct cost. Direct cost expense directly tied to a specific project or service. For example, hiring a contractor for a fit out work. Next is indirect cost. Indirect cost like overhead costs shared among multiple function or services. For example, administrative salaries and office supplies. These are the indirect cost. Then payback periods. Payback period, like for example, if we are investing 100,000 in installing some chillers or some energy saving project, so how much time it will take to return that money back? So that is the payback period. Next is profit and loss statement, a summary of revenue over a specific period. So these are the basic key financial terms used in the FM. FM budget types. So there are two types of budgets mainly in the facility management: operating budget and capital budget. What is operating budget? What is operating budget? So operating budget is generally recurring expenses for daily operations such as utility, cleaning, repairs, maintenance cost, equipment services, salaries for staff, supplies, and consumable items, and capital budget. Capital budgets are made for long-term investment or improvements such as equipment upgradation, renovation, or any fit out for any space area. What is the different in the capital budget and the operating budgets? So operating budgets handle day-to-day needs, while capital budgets deal with the major investment. Operating budgets cover short term, typically for 1 year, and capital budgets plan for long term projects spanning several years. Financial metrics and why these matters in facility management. In any kind of organization, in any kind of business, metrics are very important and they play a very important role, especially when it comes to cost, investment, and sustainability. Why metrics matter? Metrics are essential because they evaluate how cost effective facility operations are, help us determine the feasibility of capital project like building upgrade or expansion, assess long-term sustainability, ensuring that our practice align with the organizational goals for the future. Some key metrics to know. The first one is ROI, return on investment. So ROI measures the profitability of a project. For example, if you invest in energy efficient lighting, ROI will show how much you save compared to the cost of installation. Next is net present value, which is called NPV. NPV helps prioritize investment by evaluating the present value of future cash flow. This is useful for comparing multiple projects to choose the one with the highest long term value. Next is TCO, Total cost of ownership. The total cost of ownership ensures that purchase, maintenance, and operation of a resource or asset. It helps us make informed choice that maximize value over time. Using these metrics, facility manager can make a smarter decision, improve efficiency, and align with the organizational goals. Remember, metrics are very important and they are more than the numbers. They're tools to help us make a smarter decision. Importance of being finance and business aware. Financial awareness brings four major benefits. The first is better decision making. FM decisions impact operational efficiency and financial performance. Next is improved communication with the stakeholders, enable alignment with the organizational goal and optimize cost. Next is better decision making and resource allocation, effective communication with the stakeholders, increased credibility and trust, strategic planning for business alignment, financial and management accounting. Financial accounting provide data for external use, provide objective and variable financial information, and emphasize on precision, must follow external imposed rules and regulations, reflects aggregate summarized data for the entire organization, provide historic orientation records and reports on the events that have already occurred. Management accounting provide data for internal use, include financial and non-financial information, may also include subjective information not bound by any mandatory rules, reflects on organizational internal measure and whole organization records and reports on the event that have already occurred but emphasize information about future events. So in simple terms, financial accounting is for the external use, for example, to prepare the annual reports, to present regulatory authorities and shareholders and governments for the taxes purpose and to show the revenue, to show the performance of the companies. While management accounting is for the internal purpose, for example, profit and loss, expenditure, even though this is the part of the financial accounting as well, but the management accounting is for the internal purpose only. Accounting standards. So we will discuss the importance of accounting standards in facility management and how they shape financial reporting and decision making. What are the accounting standards? The accounting standards are set of rules that ensures financial transactions are recorded and reported in a consistent and transparent manner. These standards help external stakeholders like investors, regulatory authorities. So how they apply to financial management? These standards ensure that facility managers correctly report budgets, asset management, and costs associated with the building operation. Also, they help ensure that everything from maintenance expense accounted properly. What are the accounting standards? The first is GAAP. We call it GAAP. Generally accepted accounting principle. This is primarily used in US. This is provide framework of accounting and reporting. Second is IFRA, which is International Financial Reporting System. This is used internationally, especially outside the US. This ensures consistency in the reporting of financial information globally. Next is IAS, which is International Accounting Standards. Accounting records. So accounting records, what are the accounting records? There are different type of accounting records, which is a chart of account is one of them. So a chart of account is a structured list of all the accounts used by an organization to record its financial transaction. A kind of backbone of the accounting system. It organizes financial data into categories for easy tracking and reporting. It also helps classify and track financial activities, providing clarity for reporting, budgeting, and decision making. Each account is assigned a unique number or identifier or maybe code for easy reference. It also provides a clear structure for financial records, and this also facilitates accurate reporting and compliance. It also helps in monitoring budgets and financial reports. Next is ledger. This is also the part of accounting records. So what is ledger? A ledger is a representation of the account. So structure of the chart of account. So what is the structures and what are the things are included in the chart of account? The chart of account typically categorize accounts into five main groups. The first one is assets, the things the organization owns, like buildings, equipment, or cash. Next is liabilities, like what the organization owe, like loans or unpaid bills. Next is equity, which means the organization's net worth or retained earnings. Next is income or revenue, so which means money earned by the company, such as rental income or services fee. The last one is expenses, which means cost incurred like utility bills, repairs, and maintenance. A ledger complies accounting records. The general ledger is the collection of the organization's financial information by accounts, assets, liability, net assets, owner's equity or capital, revenue or expenses. The chart of accounts serves as the table of the content for the general ledger. So the ledger is where we summarize all the transactions for the journal. It breaks down each account like maintenance expense and tracks how balance change over time. Next is journals. What is journals? This is also the part of accounting records. So the journal is where transactions are first recorded. Or book of original entry systematically organize financial information by transaction type such as receipt, disbursement, payrolls, account payable. All accounting transactions are chronologically recorded in the journal before being entered in the journal ledger. The process used to transfer entries from journal to journal ledger is called posting of entries. Any entry to the journals called journal entry or journalizing. What is double entry accounting? Double entry accounting is a method where every transaction affects at least two accounts, one as a debit and the another as a credit. This ensures the accounting equation, which is asset is equal to liabilities plus equity, which always balance. Double entry accounting ensures every transaction is recorded comprehensively, supporting financial accuracy and informed decision. Next is single entry accounting. So, single entry accounting is simple and cost effective. It lacks the depth and accuracy required for the comprehensive financial management in large facilities. Imagine you purchase maintenance supply of $1,000 in cash. In a single entry system, you simply record maintenance expense $1,000 paid in cash. That's it. So, no need to balance debit and credit. This is generally used by the small or private organization to keep record of the transactions. Next is accounting cycle. So the accounting cycle is a step-by-step process for recording, classifying, and summarizing financial information to prepare accurate financial statement. The accounting cycles ensure that financial data is accurate, organized, and ready for analysis or reporting. So mainly there are seven steps in the accounting cycle. The first one is identify transaction. So when you identify transaction, you record all the financial events such as paying a utility bill. The next is record in the journals. So in this, you enter all the events in the journal with the debits and credits. Next is post to ledger. So in this, you organize these entry into the ledger by account. Next is prepare the trial balance. So in this thing, you check that your debits and credits match. The next is adjust entries, which makes correction for accuracy or deferrals. The next is prepare financial statements. In this, you generate report like income statement and balance sheets. The next one is close the book. So in this thing, you transfer net income to the equity accounts and reset temporary accounts. So this is accounting cycle. Congratulations, we have completed chapter number 1 for finance and business. This was the basic and general understanding about the finance and business. So this was the basics based on this IFMA CFM books. Thank you. Hope this video was helpful. Good luck for your exam. Happy learning.